All right, let's dive into this risk management thing in trading. It's funny. I was looking at this research you sent over, and it really hit me that you always hear about those traders, the big winners. But what really sets them apart isn't always winning. It's how they handle when things go south.
Yeah, it's like trading at its core is about probabilities. You're not going to be right every single time, no way. So the real skill is in how you manage those times when you're not.
It's like, I don't know, sailing a ship in a storm. Can't control the weather, right? But you can control how prepared you are.
Exactly. You're protecting your capital. That's the most important thing. And the research actually had some pretty intense examples of what happens when you don't, like over leveraging. Remember that one?
Oh, yeah, basically betting way more than you can afford to lose.
Hmm.
And then there was revenge trading, right? Trying to make up for losses with even riskier moves.
Yeah, that rarely ends well. The research really drives home the point that avoiding those pitfalls is all about sticking to the key principles of risk management. The 1% rule, for instance, was a big one. But it went deeper than that, too, talking about how sticking to that rule too rigidly can actually backfire sometimes.
So it's not just a set it and forget it kind of thing.
Right, like in a super volatile market, being too strict with the 1% might make you miss out on big swings. The research even suggests checking out other approaches, like the Kelly criterion.
I've heard of that. It's a way more dynamic approach.
Yeah.
Considers things like the odds of winning or losing a trade.
Exactly. It's not one size fits all. It's about understanding the ideas and adapting them to what the market's doing. Like using Monte Carlo simulations, that kind of thing.
So having a bunch of tools and knowing when to use which one.
That's it. And then there's the whole stop loss thing, which is huge. Think of it like a safety net, or maybe an emergency brake.
To keep you from going completely off the rails if a trade tanks.
Exactly. The research talked about basing your stop loss on the actual market analysis, not just some random percentage.
Makes sense. Finding that balance between giving a trade space to work and not blowing up your account.
Yeah, and it even got into some of the more advanced stop loss stuff, like trailing stops.
Which is where your stop loss adjusts as the trade moves in your favor, right?
Right, locking in profits, but still letting the trade run if it keeps going your way.
Now, we've talked a lot about protecting yourself, but what about maximizing the wins? The risk-reward ratio. That was another big one in the research, right?
Definitely. You always want to be aiming for a good risk-reward ratio, where the potential upside is way bigger than the downside you're risking.
So even if you don't win every time, those wins make up for the losses in the long run.
Exactly. Can I give you an example?
Sure, lay it on me.
All right, imagine you're thinking about investing in a new startup, right? There is a chance it might not take off, but if it does, the payoff could be huge. That's where the risk-reward ratio helps you decide if it's worth the risk.
So weighing the potential gains against the potential losses and making sure the upside is big enough.
That's it. And the research even goes further, saying you should factor in the likelihood of success, too.
Right, because a big potential reward doesn't mean much if the chances of getting it are super low.
Exactly. It's all about finding that sweet spot between risk-reward and those odds of winning. And that's where the whole position sizing thing comes in, which gets pretty interesting. It's not just about how much you risk on a single trade, but how that relates to your overall account and your stop loss.
That sounds a bit more complicated.
Okay, picture this. You've got a $10,000 trading account and you're willing to risk 1%, so $100. Now, let's say your stop loss is 5% below where you bought a stock. So if the stock's at $10 a share, you could buy 200 shares. Because if your stop loss gets triggered, you'll only lose that $100 or 1% of your account.
Ah, so I see. So position sizing is all about making sure your trade size matches your risk tolerance and that stop loss level.
Exactly. It keeps your risk consistent and stops any one trade from wiping you out.
Okay, this is all making sense, but I'm curious about the mental side of things. The research mentioned how fear and greed can mess with your trading, right?
Oh, big time. Emotions play a huge role. Fear can make you bail on a trade too early or not take a good risk when you should. And greed, well, greed can make you chase those crazy, unrealistic gains or hold on to a losing trade for way too long.
Oh, I know that feeling. It's like when you see a stock taking off and you just got to get in on it, even if it doesn't fit your plan.
That's exactly what the research was talking about. That's where discipline comes in. It's not just about having a good plan, it's about having the guts to stick to it when things get emotional.
So it's like treating trading like a business, making those rational decisions instead of freaking out every time the market moves.
Exactly. It's about being proactive, not reactive.
Yeah.
And the research actually had some cool techniques for building that discipline, which we can dive into.
This is all really making me rethink my approach. I'm definitely ready to dig into those techniques.
I think you'll find them super helpful in building a stronger, more disciplined way to manage risk.
And for everyone listening, we'll be getting into those techniques in the next part of our deep dive.
Yeah.
But let's let all this sink in for a bit first. This is some good stuff to chew on. So we've covered a lot of ground talking about those core principles of managing risk when you're trading. And you mentioned some techniques to help build discipline, keep those emotions in check. Can you walk us through some of those?
One that the research really highlighted is visualization. It's about picturing different scenarios before you even make a trade. Both the good and the bad, like imagine what you'd do if the trade goes against you. Would you freak out and sell too early? Or would you stick to your plan and manage the risk?
That's a really interesting way to think about it. It's like mentally preparing for those different outcomes so you're not caught off guard when they happen.
Exactly. You're taking the edge off those emotions. The research also talked about mindfulness meditation, which I thought was cool.
I've heard about that for like general stress and stuff, but I never thought about using it for trading.
It's all about becoming more aware of your thoughts and feelings without judging them. So with practice, you can train yourself to see those emotions like fear or greed, but not let them control your trading decisions.
So it's like putting some space between how you feel and what you do so you can make those rational choices.
Exactly. And then there's journaling, which can be really powerful. You track your trades, your feelings, the reasons behind your decisions, all of it.
It's a great idea. It's like a feedback loop so you can learn from those mistakes and make better decisions next time.
Right. It's all about self-awareness and taking responsibility for your actions. Now, switching gears a bit, the research also dug into the whole idea of back testing your strategies.
Back testing, that's a new one. What is that exactly?
It's basically taking your trading strategy and applying it to past market data. That way you can see how it would have performed back then, which gives you some valuable insights. Ah, so it's like a simulation based on real data from the past to see if your strategy actually holds up.
That's it. You're testing your ideas to see if they have the potential to make money in different market conditions.
Yeah.
And this actually connects back to what we were talking about with simulators.
Right, where you can practice trading without risking real money.
Exactly. Simulators are awesome for testing new strategies and getting those risk management skills dialed in. The research even recommended a specific website, simulator.com. It's a really realistic environment where you can experiment and see how different approaches play out, all without putting any real money on the line.
So it's like a safe space to learn and make mistakes and get better before you jump into the real market.
That's the beauty of it.
Yeah.
And you can speed up the learning process because you're compressing time. You can simulate months or even years of trading in just a few hours.
That's amazing. It's like a crash course in trading and managing risk.
In a way, yeah. But it's important to remember that simulators aren't a perfect copy of the real market. Right, because you're not dealing with those same emotions or the actual consequences of winning or losing money.
Exactly. So while simulators are an awesome tool for learning, you got to transition to live trading carefully.
Start small, manage your risk, and gradually increase your exposure as you gain experience.
That's it. And that brings us back to one of the fundamental principles of risk management that the research kept coming back to: protecting your capital.
It all starts with keeping your money safe so you can keep trading and learning.
Exactly. Risk management isn't just about avoiding losses, it's about surviving in the market. It's the base you build your trading success on.
And it's about always being willing to learn and adapt.
Absolutely. The markets are always changing, and so should our approach to risk management. What worked yesterday might not work tomorrow, so you got to be flexible, learn from your experiences, and keep refining your strategies.
This has been such an eye-opening discussion. It really drives home the point that risk management is way more than just a bunch of rules. It's a whole approach that includes strategy, psychology, and that commitment to always be learning. It really isn't like this constant process of learning and adjusting and getting better. And, that research you shared really hammered that home. One thing that stuck with me was how it talked about risk management, not just being about minimizing losses, but actually maximizing gains too, finding that sweet spot where you're taking smart risks without going overboard.
It's like walking a tightrope. You need to keep your balance, stay in control, and adapt as you go. The research talked about that risk-reward ratio as a key part of finding that balance, remember?
Yeah, we touched on that, making sure the potential win is big enough to justify the risk. But it also said you got to consider the likelihood of actually winning too, because a big potential reward doesn't mean much if the chances of getting it are like super slim.
Right. It's about lining up your risk tolerance with your profit targets and those odds of success. Basically, making smart choices based on a good understanding of the risks and the potential rewards.
So in practice, how do you actually figure out those odds of success for a specific trade?
That's where your trading strategy and your analysis come in. You need a solid strategy that you've back-tested and you trust, and your analysis should give you insights into where the market might be heading and how likely your trade is to actually work out.
So it's about combining that clear strategy with solid analysis to make good decisions about which trades to take and how much you're willing to risk on each one.
Exactly. And you got to remember, no strategy is perfect. You're going to have losses. The important thing is to manage those losses well and let your winning trades more than make up for them.
And that's where discipline and keeping your cool comes in,
Yeah.
right? Sticking to the plan even when things get a little crazy in the market.
Oh, absolutely. The research was really big on having a trading plan and actually having the discipline to follow it. It's about controlling your emotions, not making impulsive moves, and managing risk in a systematic way.
It sounds like successful trading is just as much about the mental game as it is about the strategies and the analysis.
You got it. The research even suggested things like mindfulness techniques, journaling, even talking to a trading coach to help build that mental toughness.
So it's really a holistic approach, taking care of both the technical and the psychological sides of trading.
Exactly. And something that really hit home for me from the research was how these risk management principles aren't just for trading. They're life skills. They can help you in so many areas.
Totally agree. Being able to assess risk, make good choices, and stay calm when things are uncertain. Those are invaluable skills no matter what you're doing.
It's about taking calculated risks, understanding what might happen because of your choices, and always trying to make the best decision you can with the information you have.
So as we wrap up our deep dive into risk management, I think the main takeaway is that it's an ongoing journey of learning, adapting, and refining your skills, both the technical ones and the mental ones.
It's all about constantly improving, always learning more, and getting better at what you do. And remember, even the best traders out there, they have losses too. The key is to manage those losses the right way and let those wins build up over time.
So whether you're a pro trader or just starting out, the message is clear. Risk management isn't optional. It's the foundation of success in trading, and it's a skill that will help you in all parts of your life.
Keep learning, keep practicing, and never stop trying to improve your risk management skills. And always remember, the journey is just as important as the destination.